Good morning.
Morning.
How is everyone this chilly morning? We are in the panhandle of Florida. It's 30 degrees but feels like 19, not too uncommon for us. We've also had where we've been as low as 8. A lot of people don't realize that
Mhm.
in our area, but we have the distinct pleasure which we haven't had in probably about 20 years, I guess. No, 30
Yeah,
years.
because it hasn't
We are
done it
going to
since
get
I've been
snow.
here.
The
We've
last
had
time it
yeah,
snowed here in the Panhandle was in 1994. It snowed just enough to cover the ground, and it was gone by 11.
yeah.
But this this week they are claiming that we're going to get 100% rain. It's going to be 30. What are they saying? It's going to be
I
30,
think it's like a high of 37 tomorrow and a low of
24.
yeah.
So yeah, and it has
So
100% snow. So I don't know
one
if you can see my phone
we'll
for
see
Tuesday.
what happens.
It's got a little snow
Um,
emblem.
because we've
See what happens.
we've been watching. Of course, here it wait 20 minutes and the weather's going to be completely different. So,
Yeah.
granted, waking up this morning and say it's like 20 some degrees and hold on. I'll do a post of it later. Yeah, if you haven't, we do have Facebook and all that. We
Yes.
do posts on there. So it went up a degree. So it's 30 degrees, feels like 20.
See, mine says 19.
Mine just
It's
switched.
weird. Oh,
So,
okay. Mine just switched too. That's funny.
but yes, in this area of Florida, it can get cold. There's a kind of a well, you're in Florida, it shouldn't get that cold. And then you have, excuse me, some of the people from the north um,
We
will
have
come
lived in the
down.
north. Just FYI, we have
We,
lived in
we
the
are
north.
actually from
The
the
north.
north. And we had we were at a function.
Show you where we're at. So we're the
Yeah,
little blue dot. So there's Florida. We're in the Panhandle. So
yeah,
you can see where we're at.
yeah. We're way up there. Yes, that is Florida. It is the central
Still,
time zone. Um,
and we
quick.
don't know how to drive in Florida, so
Yeah,
nobody's
no,
gonna know how
yeah,
to drive tomorrow either.
yeah. Quick. Apparently, this particular section of Florida, way back in the day, we learned this from our son. Um, was put up for sale to Alabama, and Alabama said, "Yeah, we don't want it." So that's
That's pretty
so
bad.
here we
That's
are.
pretty bad when Alabama doesn't
Yeah,
want you.
yeah. Alabama says no. You can keep that part. So here we are.
Yeah. So
But
here
no,
we
it does get cold here. Um, it's interesting when you get some of the travelers or visitors come down here from the north and they like to make fun of us. Oh, you don't know what cold. Oh, look at you all bundled up. Okay, hold on. First, I'm from Wheeling, West Virginia. Back in the day, it snowed all the time. You get up 45 minutes to shovel your car so that you can warm up your car so that you can reshovel out the driveway again so you can go to school. Okay, reason one is the why we're in Florida. Two, when I was in the Army, of course, you're in Europe. It snows in Europe, but I spent 2 outstanding years in Watertown, New York at 10th Mountain Division. And that was my first introduction to lake effect snow. This was in the 90s. And by the end of October, I think there was 3 or 4 feet, and it just kept coming. And then April and May, when it went up to 0, you're standing outside in jeans and a t-shirt because it warmed up.
Well, and that people don't realize though, depending on what region you're in, your
Yeah.
body acclimates to that. So
Yeah.
we're 100 plus degrees usually during the summer,
Mm-hmm.
so our body acclimates to that, and our here it gets really cold. I mean, like I said, one time or was it last year,
Yeah.
year before, we were 8 degrees, but it usually gets in the teens, and your body's just not used to that. So when it's 8 or in the teens, it feels
Oh,
colder than
yeah.
what it is because your body's not acclimated to that. Like they say, your blood thins.
Yeah.
So, and it's true, it does. And then when you're Wisconsin, Midwest, those northern states, where it's negative degrees, you come down here and it's like a heat wave. I mean, it's like you're in the tropics.
Well, it's like
So it just
the spring break kind. I mean, officially,
it's
It's
during
like
spring break.
March-ish, April. But the end of February is when a lot of the northern colleges
Get out.
get out on break. And the end of February, it's still chilly here. January and February are our coldest months. So we would see, you know, spring breakers, college kids, they're out there in bathing suits,
Skimpy.
in and out of the Gulf having a blast, and we're bundled up.
Mhm.
And you're like, what in the world? And someone's like, well, we're from Toronto,
Like,
or
yeah.
we're from, Wisconsin. Said it's -8 or less up there. This is a heat wave to us, and it's in the 40s.
Yeah.
So I was like, hey, drive on, thaw out, enjoy,
Have at it.
have at it.
All you, baby. All you.
Completely understand, completely get it.
Exactly. So we are going to today kind of take a shift, still on your mental health, and how your finances correlate into that. I know when we first started we partnered with a company last year, GFI, Global Financial Impact, and I've been in banking before. Didn't like how they worked. Their methodology on, providing products to their customers. And I left it back in '06 and wasn't something that I wanted to do again. I thought about getting into accounting, but neither here nor there. We ended up going a different direction. But education has always been on our forefront, on our list, because if you don't know, how do you expect to change? How do you expect, to do better for yourself? And when I was approached by the individual who brought me on, it was one of those that was very eye-opening, because the things that were explained during the even pre the I don't know, pre joining process, I guess, was just astounding to me. The fact that, I gone through my life 45 years and I didn't even know this, even working in a bank. And if you don't know somebody that knows this, how are you to know to improve your financial situation? And we don't realize that finances really do affect our mental health. And Mike can go a little more into that because he's done some research on that as well. But in general, we kind of all know that, but we just don't know to what extent. And, unfortunately, we see a lot of people during the holidays that, aren't able to cope, whether it be due to finances and they don't know what they're going to do because they're struggling. And unfortunately, look to alternative means um, to resolve that issue. And it's very disheartening to see individuals, try to attempt or succeed at that route. And if we can educate and allow people to move forward in a more conscious and, fruitful way, even if you don't have a lot to put aside, there are better ways to do it than just a bank account or the stock market. And are those things good? Yes, they are. They have their purpose, but not in the way that we've been taught. So that's something that Mike and I really strive for and are very thankful that we were reached out to, because this is something that we all really need to know.
Oh yeah. Now, when it comes to your mental health and your finances, of course, a lot of people, how can you go from mental health and then you're talking about finances? It is all very, very tightly connected.
Yeah.
So, you know, when like Tory was saying, during the holiday, you've gone through, you've spent your money, and now it's the new year, and here come the credit card bills. And now you think, well, how am I going to pay this? Well, I don't have overtime. You might have a salary job. And around here, it's seasonal.
Yeah.
So the problem here is if you took your money that you saved up during the summer and you spent it, you had a really good Christmas, which is great because you worked hard to earn that money.
Mm-hmm.
Well, now January comes around and there really isn't much going on. One of the other biggest holidays here, there was one particular place where Tory had worked, and there was nothing from November December to where you're paying your staff out of your own pocket. And the
Oh, is that
owner,
the nightclub?
yep, at the nightclub, and he had said, I can't wait till New Year's Eve because New Year's Eve will help me pay. It, dude, in a matter of 5 hours, could clear easy 6 figures. He goes, I can pay my back bills, I can pay my staff, and then it can cover me until about February ish.
Yeah.
So
when spring break kicked off.
When spring break kicked back off again. And if you're one of those and you're waiting, you're like, oh my gosh, I need this. I got this bill. I got that bill. I have to pay rent or a mortgage, and there's nowhere else to really work because here during this time of year, it's a lot of part time. You might not even get any overtime, and then if you work for your hourly wage plus tips, a lot of times this time of year, you're not getting the amount of tips that you are used to getting once, spring break and summer kicks off. Well, what does that do? Well, now it creates, you have your anxiety. Well, now I have this mounting debt. It's coming at me. That it's hard for me to get any overtime, and even any overtime that I would work, it's going to have to go to paying back bills. Yeah. So everything keeps kicking up, keeps moving. And then that's where you have your depression can kick in. So you can have your anxiety, depression, everything. And then it turns into stress, which is it like a regular stress? Yeah, it can be depending on your work situation. You know what? I can work some overtime. I can do this. I got a side job that I can knock some stuff out. I will be okay. But if it becomes where it's chronic stress, to where it is every single day, you are worrying about, oh my gosh, my finances, which comes back to a mindset. We can do something else on that. If you think that you're in the, oh my God, I'm screwed, I'm broke, what am I going to do? You'll constantly have that. If you think about the negative, you're going to constantly get the negative. You think about the positive, the more positive will come to you. I could personally write a book on that. It's interesting. Yeah. So in order to kind of stay away from or to alleviate your additional stress, anxiety, and depression when it comes to, oh my gosh, I've spent the money. Now I got to wait. I don't have enough. There's more month at the end of the money, until, it may be, spring break kicks off, especially if you're living in, one of our seasonal areas. Now, if you're in another area to where they just don't pay overtime anymore, we learned this from our son, that there's a friend of his that he games with who they called him up and said, hey, we can't get anyone to fill this shift. We know you've already worked your 40 hours, but we really need someone to come in here and do this shift. We're not going to pay overtime. We're going to pay straight time because that's what corporate says. And I'm not coming in, but we need help. Well, guess what? That's not my problem.
No, they weren't getting paid at all.
Yeah,
because that's something that it's crazy that these companies think that you're going to work for free. It's ridiculous. It's really interesting to see how the mindset of corporate culture has changed. I mean, it's always kind of been there, but to the extent that it is after COVID, it's insane.
Oh, it's mind-boggling.
Mm-hmm. Yeah.
But anyway, and that's where, a lot of you start bringing yourself down. You keep yourself in that negative loop. And you'll hear that quite a bit whenever we talk. But you keep yourself in that negative loop, and it's going to be pretty difficult to get yourself out of it. Mm-hmm. Now, we're not going to sit here and say, and I'll be the first one to tell you, people coming up telling me how to spend my money, no. So I will not sit there and say, oh, well, you know what? You buy too much Starbucks a day. You need to, if you're drinking a bunch of those and I say you might want to cut back on it, it's not because of what you're spending. It's because of all the calories and extra stuff you're putting in there inside, and you're actually trying to maybe kick back on your sugar or kick back on your caffeine, and you're trying to lose some body fat. I might say, if you're drinking 3 of them a day, cut it back to 2. Baby steps.
Yeah. Well, just for your health in general.
Just for your health in general.
Yeah. I mean,
which could
one
also
cup's
boost.
Not bad, but yeah.
Yeah, 1 cup, not bad. We looked up the calories on one of those bad boys. What was it? Was a pumpkin spice latte?
Yeah. It's like 1,200 calories.
Oh man, it was nuts. It's like
Nothing but sugar. Nothing but
Jesus.
sugar and syrup. But that's gonna be
That'd
our
be
next episode, Wednesday. We're gonna be talking about our whole body program.
yeah.
Of what the simple things that you can do each and every day, and no non-resistance habits and things like that. So we'll get into that one on Wednesday. But yeah, I mean I mean budgeting is good. If you want to talk about budgeting, we can definitely do that. That is part of our services that we can provide. But like Mike says, a lot of people don't like being told what they can and can't do, but you really have to look at, if you have a certain financial goal in mind, what do you have that you're utilizing right now that maybe you can cut back on, that can assist to get you there further. If you don't want to, that's entirely up to you. I mean, it's your budget, that kind of thing. But we focus more on the education side of it. And I want to try to see if I can pull something up here. I don't know if I can, since
I
I'm
don't know.
already in the, yeah, no. Oh, wait, nope, wrong one.
And then think about how many, what subscriptions to things do you have that you're really not using? We had found out we'd had quite a few, like, man, we haven't used that, and it might be like $6 or something.
Yeah.
But you can take those and kind of wipe those out and then put those towards something else.
Yeah, absolutely.
Like, man, I didn't know I had this. This has been coming out $10 a month. This, and they add up like,
yeah.
When was the last time we actually used this, or we signed up for a particular program? There were some things that we would use. I'm real bad about some that they would renew in a year. I was like, what, man, we haven't used this particular program for, 8 months. Yeah. And then you hurry up and catch it and say, hey, we're going to cancel it, or you're stuck with it for another year. It's like, well, if I didn't use it for a year, what am I, and that was when we were, we would do a lot of, posting, some other type of software. So, yeah. But let's see. Is it going to pull up? It might. I don't know. Can you share your screen on this?
Yeah.
Oh.
I don't have it up to where it can be visible yet, because I want to make sure to get the right spot before I do.
Sweet.
So, let's see what we got here.
So.
All right. Let me pull this up. Thank you guys for bearing with me for just a minute. Wasn't sure if I was going to do this quite yet, but
we'll give it a shot. We're going to roll through. This is actually going to be pretty interesting. A lot of and some of this are things that we never, that if I would have known some of this coming out of high school, and even when I was in the military, it could, because I was young enough still, can completely change your whole, your whole financial outlook, which can help improve your mental health, because like, wow, man, I got this.
Yep.
So
look at that. Let me see if I can adjust this.
So this is pretty interesting, and this is one of the.
I'm gonna hide myself here.
This was a particular training that we had put together. So I got an old Army buddy of mine. He's now down. He was at with Panama City Police Department. Been with a couple other departments down there. Well, now he is a sergeant over some school resource officers. Mm-hmm. And he had asked, he's like, hey, could you, before the school year kicked back off, could you maybe put together a little bit of training, one on stress management, because finances and stress go hand in hand. Because one thing we're always told, we are taught how to make money. You graduate high school. If you want to go to college and get a degree in something, you go do that, and then you work. And then if you're allowed to work overtime, you work as much overtime as you can. You work, you're told, work your ass off. Mm-hmm. And then you retire.
And retire.
But that's all they say. You work, get overtime. Oh, get certified in this, do that. Oh, you get overtime, work some overtime. Oh, learn how to do this. Work, overtime, working on the holidays, on the weekends, kids' birthdays, all that good stuff. And then what? Oh, well, congratulations. You've given us 25, 30 years. It's time to retire. Well, how do I do that? Oh, well, you put all this money in this particular account. You should be good to go. That was 20 years ago. Mm-hmm. So, which, we'll get into that. But anyway, my buddy had asked me, he's like, hey, can you come and give this class on stress management and some financial education for the one main reason that there were some of his colleagues where they'd had a, something happen in the family and they weren't prepared at all. And that one of them to this day is still dealing with the legal system about divvying up assets from, I want to say it was either his mother had passed away or a sister, or it was a family member that passed away, and he's still battling. And he was the one who asked Jimmy, he's like, hey, do you know anyone that could do this class? Because he goes, I never knew any of this stuff. I don't know what to do. I'm spending money hand over fist because we just weren't prepared because no one really taught us. It's like work, 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 work. Okay, well, what happens when you're done? So this was kind of the class we put together. It was an hour long. We're still working on it. It's a living document, but it's really, really good. It's about 30 minutes ish, give or take, unless you ask questions.
Yeah. So if you have questions, just
if you
throw 'em
have
in the
questions,
chat.
put them in the chat. But anyway, that's what started this particular class because it worked really well.
Yeah.
When Tory hit a few areas and people were like, "Excuse me, I never knew that." I was like, well, I never knew it either. I never. I'll tell you right now, I never knew that there was a cash value to a whole life insurance policy until I was 49 years old. I'm 56.
Yeah.
So that was I was like, you can do what? So anyway, I'll shut up now, and I'll pass it over to
no.
Tory.
Yeah. We got all day. We got all day. So this is kind of what we do at our classes, and I think it's so important for us to know this for just ourselves. If you have a business, just to help even improve your business. Um, so we start off, asking questions. So let us ask you this: how many of you have learned about finances at home, whether it be a parent or a relative or even maybe a friend? It's something I know in our household growing up that it was very scarce. Um, my dad was in the military and had 3 kids growing up in the 80s, So we found things to do. And I'm not saying that we didn't have a good life because we did, but it's one of those where if we had known more, where could it have potentially been? So, we can't fix the past, but let's try to improve the future. So, how many have learned about finances in school? And when Mike and I were in school, it was one of those you learned how to write a check, how to balance a checkbook, but you never learned how to save. And I think that's something that a need has arisen, and they're starting to change, at least here in Florida, to my knowledge. They're starting to implement some financial education in school. So I'm hoping that that's going to be something that's very beneficial to these young kids. And then, how many of you have learned about finances from your bank? I worked there for I've been in banking over 6 or throughout my career over 6 years, and until we came to Global Financial Impact, I never knew these things. So I never learned it from the bank. It was all about pushing products on customers, which I did not care about, especially if it was something they didn't need. But have you learned anything from your bank? Most likely not. If you have a good bank, maybe you've learned a thing or two, which is awesome. I wish more banks would do that. So what we go into next is the rule of 72. And this is an accumulation concept, or and it's based on compounding interest. So you have simple interest where it's just based on the amount that you put in. They're going to base it off that amount only. So it won't take what you've earned and add it to that pot. And that's simple interest. So whatever you put in, that's all you're getting the interest on, and that's it. Compounding interest is where you've got the money that you've put in, and then as you gain those little pieces of interest, it's going to make that pot bigger and bigger and bigger, and you're going to continue to earn interest on that interest as well. So just kind of a basic way to say that. So with this concept, I didn't know about this rule. A few people that we've come in contact with have, but it's very rare that we see people that have. So this rule was created in 1494 by Luca Pacioli. So like I said, this is not a new concept. This is something that, for whatever reason, it's not passed on. And what this concept states and what this rule states is that if you take 72 and you divide it by the interest rate that you're earning, so let's say 1%, for example, you're going to find out how long it's going to take you to double your money. Okay, so let's say it's 1%. You take 72 divided by 1 equals 72. So it's going to take you 72 years to double that money at 1%. Now, think about your bank accounts right now, especially savings accounts. Ours, I think, is at 0.35% or something like that. So it's going to take even longer. And I'm sorry, I don't want my money to take that long to double. I want my money to work better for me than, I want it to work harder for me than I worked for it, basically. So Einstein said if people really understood the rule of 72, they would never put their money in banks. Now, I'm going to say that with a caveat. He's only talking about saving for compounding interest. We need bank accounts to pay our bills. We need bank accounts for, our emergency funds, things like that. That is very important. But when banks are doing this particular process, we can cut them out and do it ourselves. And I'll explain to you what that is here in just a minute. So here, the example. 1%, it's going to double every 72 years. So let's say at 29 years old, you put $10,000 in the bank. You're not going to double that money until you're 101. Pretty eye-opening, don't you think? I mean, honestly. Let's say it was 4%. It's going to take every 18 years to double. So a little bit better, but not great. 6%, it's going to double every 12 years. So much, much better. And then 12%, it's going to double every 6 years. So when we talk to clients, we want those clients to look more at the 6 and the 12% when they're looking at certain products, because you're going to get the best bang for your buck with other, you have to look at everything. It can't just be, it's only 6%. And I'll explain to you why. Working at the bank, they told me I could never tell our clients this. Let's say they have a 5% CD. Okay. 5 months, 5%. Okay. You put your money in. And it's 5% APY, which means annual percentage yield. So if you have a CD that's at 5% APY and you only have it in there for 5 months, you are not getting that full 5%. People are like, what are you talking about? Because they're promoting annual percentage yield. You have to have it in there for at least 12 months. You have to have it in there for that full 12-month period to get that 5%. So you're getting a prorated percent because you're only in that half that time. So you may be getting, 1.98% or, 2.5%, up to 2.5%. So you really need to look at those fine prints. And I just did not like, that's one of the reasons why I left, because I didn't like how they were saying that to individuals. So really look at that fine print. You have to look at the totality of everything to really see if it's going to be beneficial for you, because everything is not correct. Each individual person is different. So you have to look at everything to make sure it's right for you. Okay. So we're looking at that 6 to 12%. So here's some questions for you. Where do you think you could find something, find those interest rates of 6 to 12%? Most people say the stock market, but the stock market is very volatile, and with everything that goes on, we've had crashes, 2000, 2008, 2020, they're going to happen, you just don't know when. But what if there was protection with that? And we'll get into that in just a moment as well. So, have you ever thought about insurance products for rates like that? Most people don't. So, let me ask you this, something else to think about. What do mortgage companies require you to have on your home to own it? Insurance, right? What do banks require you to have on your car to get a loan? Insurance, especially new cars. What do banks have to carry on your money, right? I know there was something in a few articles that I read that they're trying to get out of having to have insurance and on these bank accounts. So um, we'll see how that pans out. I hope that they won't ever go through with that because that's just silly. But kind of gives them carte blanche to do whatever. But they have to have insurance on your funds up to a certain amount. So um, it's something to think about. Insurance is a big part of our economy. It's a big part of our lives, but we don't we look at it as, oh, if I die, I need insurance, right? There's so much. It's so much more than just that, and that's what we hope to kind of tell you guys today. So, do you know what Walt Disney, Pampered Chef, and J.C. Penney all have in common? Most people don't. There is actually a book on this. If you'd like that book, we have it. It's free. Let us know in the chat, and we'll be happy to send that to you. We just need your email address, and we can get that to you. But it's very, very interesting. So, when Walt Disney tried to open Disneyland in California, amusement parks during that time were very looked down upon because they weren't family friendly. You had a lot of crime that happened, especially at night, and banks did not want to have that liability. We're going to give you all this money, and amusement parks right now, they're not profitable. So it was a risk they didn't want to take. So what Walt Disney did was he actually accessed his cash value and his insurance policy to start Disneyland. And a lot of people don't realize that. Same with Pampered Chef and J.C. Penney. They did the exact same thing. So this is huge. And as we educate, we've had people that flip houses. One in particular, he kept going to the bank and kept getting loans. I mean, as soon as he'd flip it, somebody bought it, he paid it off. But what he didn't realize is that it kept hitting his credit report. Every time he got a loan from the bank, it hit his credit report. So around the 8th, 9th, maybe even 10th time he went in, they're like, I'm sorry, we can't lend to you. And he's like, what are you talking about? I get a loan, I paid it off. Well, every time he would go in, because it hit his credit report, it lowered his score. And they wouldn't help him out. They wouldn't provide him another loan. So what he did is somebody told him about life insurance. And what he did is he borrowed against his life insurance policy from the cash value. He would get a house, flip it, keep whatever he wanted out of it, and he would pay off the loan, or he would pay off the loan to the insurance policy. Most insurance policies, they do have a loan fee anywhere from 3 to 5%, but much better than what you would ever get from a bank. And it's not hitting your credit score each and every time you take a loan from it. So really, really big. It's just another tool to be able to use not only for death, but while you're living as well. Okay. So a good point is that during the Great Depression, only 14% of insurance companies were lost. So out of 438, only 63 companies were actually lost during that time. And there's a great article. It's a little dry, I will tell you, because insurance is a kind of a dry subject. But infinitebanking.org, there's a great article in there about banks versus insurers during the Great Depression. And it kind of goes into a little more of like the legal side, the law aspect of it, and how they structured it to work. But the fact that they still made it and most banks didn't, I mean, that's huge, isn't it? I mean, crazy, crazy, crazy. So I didn't even know this either. So, but really, really interesting article. So now what we like to say, we kind of know the rule of 72, how it accumulates. But then what is the strategy that helps it to grow? Okay, we know, okay, the compounding interest, how does that actually work? Okay, so with that being said, most of us know what a fixed rate is. And what this strategy is basically your savings account. You're at a fixed rate of interest, and it doesn't increase for inflation. It doesn't increase for cost of living. None of that. It's just kind of that flat line. If you're in the medical field, you know what that's like. It's just dead as a doornail, right? And like I said, right now it's very, very low, on usually under 1% right now. Okay. Then you have your variable, which is the stock market. As it goes up, you benefit from the upside. As it goes down, unfortunately, you take that risk and lose money during that downside. Now, what most people don't realize is that there is an indexed strategy, which takes the best of both worlds. And like, this is too good to be true. Well, it's how the insurance companies and these regulators have structured it through insurance policies to make this work best for the individual. Okay, so it's not too good to be true. It actually works. Many people do it. The Rockefellers do it all the time.
Yep. And indexing's nothing new.
Mm-mm.
It came out in the 80s with a broker. If you remember back in the day, my broker's E.F. Hutton. And when E.F. Hutton talks, people listen. He is the one who came up with indexing in the 80s.
Yep. So why don't we know about this? Why haven't we been taught these things? Well, we definitely want to teach you that now. So as it takes the best of both worlds, as the stock market goes up, right? So let me back up just a second. So indexed accounts mirror the stock market. Well, what does that mean? So an indexed account is a completely separate account that holds your money, and it watches the stock market. So it's like looking at it, and as the stock market does its thing, they look at the percentage that it's at, and they base your crediting on that. Okay, so your money is not actually in the market, but it mirrors the market. So as the stock market goes up, so does your funding, right? So depending on how it's structured, the amount, maybe you're capped, which means you can only get a certain rate. But there's a floor of 0. So you can never go below 0, unlike the stock market, like you see here. So as you go up, again, you benefit just like the stock market from those potential gains. But as the stock market goes down, this is where the fix comes into play, and you are locked in place. Now, what that means is, it doesn't mean your interest rate is locked in place. It means that your money is locked. So you can't lose a penny. Yes, I will say that again. You cannot lose a penny. You might not gain anything, but you won't lose. We know somebody in 2020, when the crash hit, that he lost over $300,000 from his 401k. He did not know what he was going to do. That's a huge hit for your retirement, because mutual funds are in the stock market. It's very, very volatile. And as the closer you get to retirement, is that a chance that you're willing to take? I know everybody pushes 401ks, but we really need to understand how they work to see if it's beneficial for us. As it comes to tax time, your CPAs are going to maximize your yearly deductions, and that's part of it, which is great, but let's look long term. Okay? So as we are locked in place, again, we may not gain, but we're definitely not going to lose. But as the stock market goes back up, guess what happens? We start earning again. But as the stock market drops, guess what happens? We're still locked in place, so we won't lose a penny. We may not gain, but we won't lose a dime. So this is something that's really, really beneficial. And, for us to understand how really powerful this index strategy really is and what it can do for us. Because if the individual we know had been in something like an index strategy, he wouldn't have lost all that money, especially because he's getting closer to retirement. So really unfortunate that that was the case. So how our money gets taxed, we know Uncle Sam's always going to get his portion. Never fails, right? So there's different kinds. It's tax now, like your bank CDs, your savings accounts, mutual funds, brokerage accounts. Anytime you take that money, you have to pay taxes on it. If you roll it into something else, you don't have to pay. You're just deferring that. But that's kind of the next thing, which is our tax later, our tax deferral, which is like your savings account or, retirement savings accounts, like your 401ks, your IRAs, certain annuities, not all annuities, and definite pension plans, because you put money into those accounts before you get taxed. That's where your CPA can, give you that benefit because it's lowering your income, for that year. And, you have deductions and things like that. But that's you're going in it in the premise that, okay, I'm not paying taxes on it now, but when I get to retirement, I'm going to have to pay taxes on that money as I start to receive it. And what a lot of people don't understand is that taxes will continue to go up. It's an unfortunate part of it. But most of us don't realize that usually because of the money that we've earned, now we're in a higher tax bracket because of all of that time that we've worked. So now you're in a higher tax bracket, and now you're having to pay higher taxes on the income that you are anticipating for retirement. And what a lot of people, something else that most people don't understand is when you have accounts like that, your retirement accounts, most of it is gone within 10 years. And we can show you how if you are interested in seeing that diagram. It's really astounding. I didn't even know, because that's something we were always taught. Put it in a 401k, put it in a 401k. You listen to all these gurus talking about it, and it's like, well, they know what they're talking about, but they're looking at the now. They're not looking at when it's time to retire, what that's going to look like for people.
Mm-hmm.
Maybe they do, and they just have special interest in it. A lot of them do. A lot of them have special interest, and that's why they push things as hard as they do, which is very unfortunate, because you need to look at the individual person, and that individual person has to decide what's best for them. And the fact that most people don't really understand what a 401k is or a pension plan really does when it comes to retirement, it's really astounding. So, tax later, you're going to pay taxes when you start taking that money. And then there's tax advantaged, where it's going to be like your cash accumulation and your insurance policies, executive bonus plans, municipal bonds, and even Roth IRAs. So what this means is you've already paid taxes on it, on that money, and then you've put it into something, some type of instrument or policy. And the reason being is that you can't get taxed twice on that. Uncle Sam can't double dip. So pay taxes on now when you know what your interest rate is going to be, or not your interest rate, your tax rate. And then allow that money to grow tax-free. There are products out there that you can retire with tax-free income. And it's through insurance policies. It's crazy that we're never taught this. Could you imagine how many people wouldn't have to go back to work after they've retired and exhausted all of their funds from their retirement plan that was a tax later? Crazy powerful, guys. Something really to think about, isn't it?
Well, we got one decided, I'm going to start collecting my pension right now because I worked for it. I earned it, and I'm going to take it. Well, started drawing his pension before he was 59 and a half.
Yeah.
And he is 7 years into it. And in 3 years, he is going to be out of money.
Yep.
No shit. True story.
Yeah. And it's unfortunate because the individuals that are running those accounts or facilitating, I won't say running, that are facilitating those accounts through your employer, they probably don't know a lot about it either. They're just kind of doing those transactions for you. But the fact that he was never told, hey, because you're 59 and a half, you're going to get an extra 10% of tax charged to whatever amount that you're taking out. So right now he's like 30+% in taxes because he's taking that money early. Stuff that we're never taught. Stuff that we don't understand, that our money could be lasting a whole lot longer than what it is. So this is where our education comes into play. Huge, guys, huge. All right. So what stood out to you the most about these three concepts? Was it the rule of 72? Was it how money grows, or was it how money got taxed? What part of those three really kind of stood out to you? And then financial services that Mike and I offer. So we do the tax-free, tax-advantaged wealth accumulation. If you're looking for something to really be beneficial to you in retirement, this is the route you want to go. Asset protection. We do a lot of 401k rollovers. A lot.
And if I may jump in, if you've got an
Absolutely.
old 401k, like you've got one with, and I've known people they've had, I worked for this person for 5 years, this place. If you've got an inactive 401k sitting with an old employer,
Yep.
you're not being told about the fees that you are actually paying on that. And this is where our rollovers come in. Like, you mean to tell me that? Yeah. And then we have a particular piece of software that can show,
Yep.
like, this is what you're paying in fees. This is what's going to happen. And this is where a lot of our rollovers come in, because it's not doing you any good. You might as well just give your credit card to your ex-spouse.
Yeah. Yeah, I mean it's something that we're not taught. So while you have that 401k, yeah, your company might be contributing to it, but what they don't tell you is they're paying the fees as well. So it is beneficial, but if you stop working for that company and you leave it with that company, you're no longer getting their contribution, and now you are responsible for the fees. So it doesn't make sense to leave it with them. And they may send you, oh, you gained 12% in in interest this year in that account, but what they're not showing you is how much you paid in taxes and fees. So your accrual is different from your actual gain. Something else they don't tell us. So very, very valid point, Mike. Then college funds. With these structured plans that the states provide, they're very restrictive. They're trying to loosen some of that restriction because a lot of people aren't utilizing those plans anymore. But what if you could do it and not have any restrictions? Just like the guy who's flipping houses. He can use that for whatever he wants. He can loan and pay it back. You can do the exact same thing with an insurance policy. But if they decide they don't want to go to college, guess what? You're not out any money. You don't have to find somebody else to give it to. You don't have to roll it into something else. The money can be theirs. They can use it to buy their first house. They could use it to buy their first car. Doesn't matter. They don't have to use it at all. Start their own business. Exactly. They have no restrictions. So a lot more leeway and flexibility. And then debt management and consolidation. People don't look to insurance products to help get out of debt. And when I saw this for the first time, it just blew my mind. I'm like, holy crap, I never knew about this. Really powerful stuff. Infinite family banking. It's where you can borrow against yourself and you don't have to worry about going to a bank to pay these, crazy interest rates of 10 to 12%, depending on what your credit score looks like. You can borrow against yourself at like 3 to 5%. And if you pay it back, great. If you don't, well, guess what? It just comes out of the death benefit. You have more flexibility. life insurance and illness protection. So this is big. Life insurance, everybody knows about that. Okay, I get a life insurance policy. It helps me when I die. Helps me and my family when I die. Yes, it does. But a lot of people don't realize if you get a, a really good policy and you're getting that cash value, you can borrow against yourself. You have more flexibility. But also, term insurance has changed a lot just in the last 20 years. Term insurance even has, excuse me, living benefits. Well, what is that? Well, if you became critically, chronically, or terminally ill, depending on the policy, you could utilize those funds to help you through that time. Because when you get critically, chronically, or terminally ill, you're not going to be able to work. How are you going to pay for just your daily things? Well, guess what? They've adjusted term insurance to where now you can have access through living benefits. That is powerful because term insurance, you have that block of time. If you don't die in that time, I'm so sorry. But now with cancer rates going up, illness rates going up, that gives you more kind of peace of mind knowing that, at least I have this policy for 20 years. And if something were to happen to me in that time frame where I'm out of work for a while, at least I can access it and have those funds to help me. So huge. And then living trust, wills, and estate planning. We don't realize how really, really powerful this really is and how much we need these. Like Mike said, they're the individual that, had a family member pass away. They didn't have a will, so everything went to probate. And then being in probate, it can stay there for years. If you have a will, usually average time for it being in probate, because it still has to go to probate to verify all the information. It can be there anywhere 6 months, maybe up to, about 3 months to 6 months, usually, just to make sure everything's in order. They want to clarify before they, process everything. But if you don't have a will, then you get the court involved. You'll get probably a guardianship. It's a mess. And you're looking 3 to 4 years, depending on how much you've got. That's where planning is so important. Trusts are going to be your best option. Definitely, we have companies that we work with, because we work with so many of them, that if you have a policy with them, they'll provide this for free. And there we also have an individual that's actually a coworker of ours who is an attorney that is in the financial field with us, and he will hand walk you through everything. And
he's been doing trust for 30, 40 years.
Yeah.
Because of something that happened with his family and probate and the courts.
Yeah.
He's like, I need to jump in on this.
Absolutely. And if you think it can never happen to you, that's not a good way to look, because when you least expect it is when it happens. I'm not trying to be making you paranoid or anything like that, but this is something that we really have to look at. Nobody plans on getting sick. We plan on living for a long time. Mm-hmm. But for some of us, that's not the case. So we really need to plan. If we plan now, it's a hard topic. But if we plan now and set our family up for success later on down the road, when we're not there, we have peace of mind too, knowing that they're taken care of. So something to think about. And then, of course, index growth products, which we discussed. Business owner strategies. We do a lot of key employee insurance. So if you lost a key employee, you would have that insurance, to kind of help get you through, maybe find someone else to fill in that slot, whatever the case may be. And then, of course, final expense. Right now in Florida, final expense policy, they're going to be a lower face value amount. So usually, it can go up to $100,000, but, $50,000, whatever it may be, but it's going to be a lower face value amount to just cover those costs of your final expense. Now in Florida, a basic funeral with casket is around $10,000. Looked it up for somebody because they asked, well, what if you're cremated? Well, even cremation, if
That
you do a
was
service and everything, you're looking $7,000. So, you know, 7,000 to $10,000, is that something that you have in your pocket if something were to happen to somebody that you loved? Would they have that set aside to cover their final expense? Really, really tough to think about, but it's something that we need to think about because, you see so many GoFundMe's. Do they help? Absolutely. But if you plan ahead, you don't have to stress out, oh, am I going to get enough money to cover this through that GoFundMe?
like our team members up in Pensacola. His story when he was working, uh, he was a funeral director,
Hmm.
and it came to the final. When talking about final expense, I'll make this real quick, kind of. But his family are funeral directors. That was the family business, and this is one that he was talking to us. Well, actually, when Tory first got on, before I jumped on board, and he said he had a family there, maybe family 3 or 4, and they were arguing back and forth about, well, Uncle so and so wanted, no, we want it, no, we need it, no, he needs this, he wanted that, and he finally stopped and said, Is there any life insurance at all?" And they're like, "No." "Was there any final expense insurance?" "Well, no, there was nothing. We're gonna have to pay out of our own pocket." And he said, "Okay, who's writing the check?" One person raised their hand and said, "I'm paying for all of it." He said, "Okay, you stay here. The rest of you leave the
Hmm.
office."
Yeah.
He who holds the money is the one who's making the decisions.
Yeah.
If there would have been a policy in place, it would have been, okay, this is what the policy covers. Good. We can do A, B, C, and D the way your family member wanted it to be.
Yeah. And it's unfortunate, but that's what happens when people when finances and money is involved. People get very very picky. They get snappy, especially when it comes to family members. And it's very unfortunate that you have those arguments in that situation. You have enough to worry about with trying to take care of, you know, putting your family member to rest. That's a very stressful time for most people. And do you want finances to be a part of that stress? If we just plan ahead, we don't plan to fail, we just fail to plan. And that's a big part of it. So if we can bring awareness to that planning, we definitely will. And then this is a pension thing. It really doesn't apply. But, this is something that has been really a passion of ours to help people understand how that money grows, because again, you have a lot of people during the holidays that, you know they think that taking their life is the only way out, and that's very unfortunate. But we haven't been taught other ways, better ways. I mean, that's not the only reason during the holidays for mental stress, but it's something that if we can educate on how much how much or how better of a situation would that put you in during that time.
Mhm.
you know I mean, you see marketers are amazing when it comes to TV. Oh, you buy this is on sale, and it's like, oh, you think you're getting a great deal, and we spend all this money during the holiday season, because we want people to know how much we love them through gifts. But what can do better for you? Maybe is it cutting back on the budgeting during that time, you know watching what you're saving, watching what you're spending, with those budgets. And if that's something that you guys want to learn more about, we'll be happy to do something on that as well. But finances have such a powerful impact on our mental health.
Mhm.
And, you know, the stress and the strain during the holidays. And I mean, and even now with, inflation the way it is, we need to look for better ways to save and to, save for retirement. for sure.
Absolutely.
Yeah. But, if you feel that you don't have enough to be able to save, it doesn't take a lot. It really doesn't. Sometimes just $50 a month. And, that could be maybe a couple weeks at Starbucks, like Mike said earlier. What are you willing to give up to kind of secure your future and, to provide that safety? And, it's one of those, it's like, oh, and somebody else telling me about my finances. Well, we want to educate you. And that's our main purpose, is to really educate and to see. But, bank accounts are definitely not the way to grow your money. And that's a big point, definitely, that we wanted to get across. Stock market, if you have that money to lose, that's awesome. You just know that it's not guaranteed. And a lot of insurance products, it's not guaranteed either. But the historical gains that they show you in those are much better than than anything you would find in the banking industry, and even, the stock market. So because with the stock market, it's so volatile, it's not guaranteed, that you would get to keep that money. Well, with index strategies, whatever you've gained, whatever you earned, you get to keep that. That's a guarantee. You get to keep that. Interest rates aren't guaranteed, but you'll never lose a penny. That is guaranteed. And it's something we need to educate more. We need to get that education out there because of how imperative it is. So,
Yes.
yeah. But just know, if you have issues, if you are struggling, start with a budget. You can go online, get some free templates um to really help give you some guidance on maybe where you can kind of tailor that. I mean, there's some apps out there, like Mike said, you got like, 10 million subscriptions somewhere that you're not even using. I mean, that's just a waste of money. So, really capitalize on that and then put that into something. You know, sometimes, do we really need that fourth or fifth cup of coffee from Starbucks, or Dunkin' Donuts, depending on where you're out in the country,
Oh
or,
yeah.
or, Caribou coffee, which is so good.
Very good.
Scooter's coffee, which is so good.
Yes.
So, but do you need it, that many times a day? And really just kind of what's going to be more important to you, having that cup of coffee or securing your future? And I think and it's not difficult. It's just something that we really need to prioritize what we want our goals to be. And that's really what it's about. It's what is your goal? Do you want to retire by the age of 50? Do you want to and still have tax-free income? Um, do you want to are you somebody who just really likes to work? And that's fine too. If you
Oh
want to
yeah.
keep working into your 70s. My dad's that way.
Still working.
Still working, So it's one of those where, what's going to be best for you. And you can still do these plans, but your goal's going to be different. So, we've had people that got into a product, which is very unfortunate, that their agent was not as forthcoming with them as they should have been, but would put them in an income product where they're not gaining anything, but all their money's coming out. So
Mhm.
they're just dwindling that balance. And what we were able to do is put them in an accumulation to where they're still having to take a certain amount, just regulatory for the IRS, but they're still earning income as well through that accumulation. So we really sit down with each individual to see what their situation is, what their goal is, and we tailor something to them to fit what they need, because everybody's needs are different. Just like with mental health, everybody's needs are different. We've all
Mhm.
gone through different experiences. We've all, had some trauma at one point or another. If we don't deal with it, it creates more hassle for us later on down the road. And, if you haven't listened to any of our future or our previous streams, please do. about negative programming and hypnotherapy. Really important stuff. So we hope this has been beneficial. We hope that you've enjoyed the education. If you have any
Yes.
questions, please let us know. Mike, did you have anything
No, I am good
else
right
to add?
now.
All right, guys. Well, we hope that, if you're working today, we hope you have an amazing day. If you're off today, definitely enjoy that time. I'm sure
Mhm.
some of you are sleeping in, which I don't blame you.
Oh, it is
We
a
would have
holiday.
too.
I forgot
Yeah,
about that.
today's a
I forgot
holiday.
about. Yep.
Yep, Martin Luther King Jr. Day. Um, you know, he had a dream, and with GFI, we're educating people to dream again, so that they can see that bright future that they could potentially have. So we look forward to seeing you guys on Wednesday, which we'll probably do
Yes.
something about our whole body program, which is, we'll get into a little bit more, but it's about your internal awareness, really that holistic approach to your health,
Mm-hmm.
and really powerful things that we didn't know, especially as we start to age, that we really need to be focused on with our diet and just awareness in general. And
If you're looking for that permanent positive change, like we're talking about the New Year's resolution, this is where it all kind of comes in. You have your unconscious transformation and your conscious transformation. This Wednesday we'll talk about, it's going to be your conscious transformation, to where, okay, I see what's going on. I'm watching. I'm listening. I'm, if you wake up and you actually dread having to do something, or you're starving yourself and you feel absolutely miserable, that's not sustainable.
No.
There's some that think, yeah, I can do it. I'll do it for 2 or 3 months or however. It's really not that sustainable. That's where you get your yo-yo, what you call it, the yo-yo dieting, but you're kind of working out. But we'll get into that on Wednesday. It's actually pretty interesting. It's not as complicated as anybody would think. When we were going through the class, we had someone in the class, but we actually had quite a few medical doctors and some nurses in the class who they're like, we've had enough. We want to see something different. Well, one lady, she used her dad as, hey, you're my test subject. And he ended up going to have, just during the time, because it was a 4-month class, ended up going to the doctor, having his checkup, and the doctor's like, what are you doing? He goes, I don't know. I'm doing this thing. My daughter put me on this program. This is what it's called. He goes, don't stop. He was actually able to pull himself off of certain medications because of just some twists in, your habits and kind of eating.
Yep.
And a lot of it, you may find, will come from some of the food we eat can cause inflammation.
Yep.
So anyway, we'll get into that.
Yep.
Yep.
Absolutely. So give you a little taste of what that's going to be like on Wednesday.
Yes. Yes. So yeah.
Yep.
Tell your friends about that one.
Absolutely.
That one will be really fun. Not that this one wasn't fun, but whole different topic.
Absolutely. So we hope you guys have an amazing week, guys, and we'll see you on Wednesday.
Perfect. Have a great day.
Take care.
Thanks.